Stop scrolling right now. Markets closed 2 hours ago, and what just happened in today's session proves everything I am about to tell you. This is the Asian guy. It is Monday night, February 2nd, 2026, and I have spent the last 7 hours tracking every tick, every volume spike, every institutional flow in the silver market. And what I witnessed today confirms that Thursday's 26% crash was not a correction. It was a coordinated strike designed to shake out retail holders, liquidate leveraged positions, and reset a narrative that was becoming too dangerous for the entities controlling the paper market. But here is what they did not expect. The plan failed. Silver opened Monday morning at $85.15. Industrial buyers treated the crash as a discount. Physical premiums spiked instead of collapsing. And the short sellers who thought they could cover their positions at $73 discovered there is no metal available at any price. I just finished analyzing Monday's closing data, and the numbers prove we are staring at a liquidity crisis that is going to detonate Tuesday morning. Let me show you exactly what happened today and why the next 12 hours are going to separate the people holding physical metal from the people holding worthless paper claims. Thursday, January 30th, silver crashed from $118.58 to $73.67 in a single session. That is a 26.26% collapse in hours. Not a correction, not a pullback. A vertical drop executed by bullion banks dumping thousands of futures contracts into thin Asian session liquidity. Gold fell 9% the same day. Brutal, but silver got butchered. By Thursday's close, silver had recovered to $85.15, proving the entities that triggered the crash were not trying to destroy silver permanently. They were trying to trigger stop losses, liquidate margin accounts, and terrify retail investors into never touching silver again. That was 72 hours ago. Today, Monday, I watched the market open expecting capitulation. I expected panicked selling. I expected dealers flooded with inventory from retail holders dumping metal at any price. That is not what happened, not even close. Physical premiums on Monday did not compress. They expanded. I spoke to 4 different bullion dealers in the 6 hours after markets opened this morning. Every single one told me the same story. Phones ringing nonstop with buyers, not sellers. Inventory tighter than it was before the crash. Premiums over spot climbing, not falling. One dealer in Texas quoted me $12 over spot for American Silver Eagles this morning. Before the crash, premiums were $8. Another dealer in California told me his weekend was flooded with orders from industrial users locking in forward contracts at prices far above the COMEX quote. These are not speculators. These are manufacturers who need silver to build solar panels, electronics, batteries. And they saw Thursday's crash and interpreted it exactly the way I did. The paper price just disconnected from physical reality. Time to secure supply before the gap becomes impossible to bridge. But here is where it gets terrifying. I analyzed Monday's COMEX volume data. Open interest dropped significantly. That means contracts were being closed, positions liquidated. In a normal market, falling open interest during a price recovery means short covering. Sellers who drove the price down on Thursday should be buying back contracts today at higher prices, locking in profits. But the price action does not match that pattern. Silver barely moved today. It opened at $85, drifted to $87, pulled back to $84, and closed almost exactly where it started. Flat. Dead. No momentum in either direction. So if shorts are covering, why is the price not moving? Only one explanation. The contracts being closed are not being settled with metal. They are being settled in cash. Buyers who stood for delivery, who demanded physical silver, are being told there is a delay, a logistics issue, a processing error, and instead of metal, they are receiving cash compensation based on Friday's closing price. That is not delivery. That is default disguised as settlement. Let me explain what that means. The COMEX operates on a system where most futures contracts are never intended for physical delivery. Traders buy and sell paper contracts, speculating on price movements, and the contracts expire worthless or get rolled into the next month. But a small percentage of contracts every month stand for delivery. Those holders submit a notice saying, I do not want to trade this anymore. I want the actual metal delivered to my vault. And the COMEX is legally obligated to match those delivery demands with physical supply from registered vaults. Except right now, they cannot, because the registered inventory is not there. Thursday's crash triggered massive delivery demand. Buyers saw the discount and said, this is my chance to convert paper into physical at $85 instead of $118. They stood for delivery. They submitted notices. And the COMEX is scrambling because the vaults do not have enough metal to honor those claims. So instead of admitting that, instead of triggering a public panic by announcing we cannot deliver, they are quietly settling in cash and calling it a processing issue. I confirmed this with two separate sources in the wholesale market today. Both told me the same thing. Delivery delays are spreading. Metal that should have been allocated last week is still pending. Vault transfers that normally take 48 hours are now taking 7 days. And the official explanation is logistics congestion due to high volume. That is corporate language. That is the phrase you use when you cannot say we lost track of the metal and we do not know where it went. This is not a liquidity issue. This is insolvency. And Monday's flat price action proves the COMEX is desperately trying to prevent discovery. Because if the market realizes delivery is failing, if industrial buyers start demanding physical and the exchange cannot provide it, the entire paper pricing mechanism collapses. And once that happens, the only price that matters is what you can actually pay to get metal in your hand, not the COMEX quote, not the futures price, the physical street price. And that number is already $12 above spot and climbing. Now let me show you what happened in the 3 days between Thursday's crash and today's session. Because the institutional behavior during that window tells you everything about who orchestrated the dump and why. Thursday, the crash happens. Silver falls 26% in hours. Billions of dollars in paper wealth evaporates. Margin calls trigger force liquidations. Retail accounts get wiped out. By the close, silver is at $85 and the narrative is chaos, volatility, risk. Friday, markets reopen. You would expect follow-through selling, you would expect fear. Instead, silver holds $85 all day, does not break lower, does not spike higher, just consolidates. That is not natural, that is managed. Someone is defending $85 as a floor. Why? Because if silver breaks below $85 after a 26% crash, it signals complete collapse. It tells the market the bottom is not in. Panic accelerates. But if you hold $85 for 24 hours, you create the illusion of stability. You make it look like Thursday was capitulation and Friday was the bounce. Perception management. Saturday and Sunday, markets are closed, no trading. But the physical market does not close. Dealers are open, buyers are calling, and premiums are spiking. I tracked weekend premiums across 6 major bullion dealers. Every single one raised prices. Not because the COMEX quote went up. It did not. Markets were closed. But because demand for physical metal exploded and supply tightened. By Sunday night, premiums over spot had climbed to levels not seen since the 2020 COVID panic. That is not normal weekend activity. That is a physical shortage unfolding in real time while the paper market is offline. Then Monday today, markets reopen. And instead of selling, industrial buyers accelerate orders. Instead of collapsing, premiums expand further. And instead of covering at lower prices, the entities that dumped the market on Thursday are now trapped, because they sold contracts expecting to buy them back cheaper. But there is no physical metal available to cover those contracts at any price. Let me be very specific about what this looks like from the institutional side. A bullion bank holds a short position of 10,000 silver contracts. Each contract represents 5,000 ounces. That is 50 million ounces short. On Thursday, they dump contracts aggressively into the Asian session. The price crashes from 118 to 73. Margin calls trigger. Retail longs get liquidated. The bank watches the cascade and waits for the bottom. Their plan is to cover the short position at $73, lock in a $45 per ounce profit, and walk away. Except when they try to cover, they hit a problem. There is no metal. The contracts they sold were paper. But to close the position, they need to either buy back the contracts or deliver physical metal. And the physical metal is not available. Industrial users already locked it up. Wholesale buyers already claimed it. And the COMEX vaults are running dry. So instead of covering, the bank is stuck. They cannot close the position without spiking the price. They cannot deliver metal they do not have. And they cannot admit the problem without triggering a panic. This is the trap, and Monday's flat price action is the evidence. If shorts were covering successfully, the price would be rising. If longs were panicking, the price would be falling. But the price is frozen because both sides are paralyzed. Shorts cannot cover. Longs cannot sell. And the only variable that can move is physical premiums, which are exploding. That is not a stable equilibrium. That is a system under extreme stress. And stress does not relieve itself. It accumulates until something breaks. Tuesday morning, one of two things happens. Either the COMEX announces delivery delays and tries to manage the narrative with technical language and processing excuses, or short sellers panic and start buying at any price to avoid forced delivery they cannot fulfill. If it is the first scenario, the market interprets it as default. Physical premiums spike to $20, $30, $40 over spot as buyers flee paper and scramble for metal. If it is the second scenario, we see violent repricing. Silver gaps up $15, $20.25 in the first hour as covering demand overwhelms available supply. Let me show you why I think the second scenario is more likely. The entities that crashed silver on Thursday did not do it to profit from a short position. They did it to prevent silver from reaching $120 and breaking free of paper market control. But the crash did not solve the underlying problem. Industrial demand did not vanish. Physical supply did not materialize. The deficit did not close. The only thing that changed is the number on the screen. And that number is now so disconnected from physical reality that it cannot hold. I analyzed lease rates today. Silver lease rates are inverted. That means it costs more to borrow silver for short-term delivery than to buy it outright. When lease rates invert, it signals physical tightness. It means the entities that normally lend silver to suppress the market are hoarding it instead because they are not confident they will get it back. That is not a temporary condition. That is structural failure. I also analyzed inventory data at major COMEX vaults. Registered silver, the category available for delivery against futures contracts, has been declining for weeks. Every ounce that leaves registered inventory is an ounce that can no longer be used to settle contracts. And the outflow is accelerating. In the 2 weeks leading up to Thursday's crash, registered silver dropped by 4.7 million ounces. That is metal moving from available for delivery to allocated or withdrawn entirely. After the crash, the outflow did not stop. It accelerated. Another 2.3 million ounces left registered vaults between Friday and today. Do the math. In 3 weeks, the COMEX lost 7 million ounces of deliverable inventory, and we are in the middle of a delivery month. That is not normal drawdown. That is a run on the vaults, and the entities managing those vaults know it, which is why they are settling contracts in cash instead of metal, which is why delivery delays are spreading, and which is why Tuesday morning is going to be chaos. Here is what I am tracking in the next 12 hours. First, Tuesday morning delivery notices. Every month, the COMEX publishes data showing how many contracts stood for delivery and how many were actually settled with metal. If Tuesday's report shows a significant gap, if delivery notices exceed actual settlements, it confirms default. The market will interpret that as the COMEX cannot fulfill its obligations. Physical premiums will explode. Second, open interest changes. If open interest continues to fall on Tuesday while the price stays flat or rises, it means contracts are being closed without metal changing hands. Cash settlement. Default by another name. Third, physical premiums at major dealers. If premiums continue climbing above $12, $15, $20 over spot, it proves the paper price is irrelevant. The only price that matters is what you can actually pay to get metal delivered. And once that gap becomes obvious to everyone, the paper market loses all credibility. But here is what nobody is asking. Why did this happen now? Why did the bullion banks crash silver on Thursday, January 30th, instead of 3 months ago or 3 months from now? Because the timing was not random. It was calculated. And when you understand what was happening in the week before the crash, the whole strategy becomes clear. In the 7 days leading up to Thursday, silver was accelerating. It was not just rising, it was decoupling. Physical premiums were climbing. Lease rates were inverting. Industrial users were locking in forward contracts at prices far above the COMEX quote. And every single one of those signals was proving the same thing. The paper price was losing credibility. People were starting to ignore it. They were treating it like a reference point, not a real price. And if that trend continued, if silver kept climbing while physical premiums kept widening, the entire control mechanism would collapse. Because once the market stops trusting the COMEX price, the COMEX loses its ability to set the price. And once that happens, the bullion banks lose their ability to manage the market. So they acted. They waited for a moment when liquidity was thin, Thursday morning, Asian session, and they dumped enough contracts to trigger a 26% crash in hours. They did not care about the optics. They did not care about the questions it would raise. Because the alternative, letting silver run to $120, $130, $140 while physical premiums exploded and industrial users panicked, that was worse. That would have exposed the system, and exposure is the one thing they cannot afford. But here is the problem. The crash did not fix anything. It bought time, maybe a week, maybe a month. But the forces that pushed silver to 118s are still there. Industrial demand is still rising. Physical supply is still constrained. The deficit is still widening. And every day that passes, the gap between paper and physical grows. Monday's session proved that. The crash was supposed to terrify retail holders into selling physical. It did not. It was supposed to collapse premiums. They expanded. It was supposed to give shorts room to cover. They are still trapped. which means the pressure that triggered Thursday's crash is still building. And the next time it breaks, the move is going to be even more violent. Because every crash like Thursday teaches physical buyers exactly what to do next time. When paper dumps, buy physical. Do not panic, do not sell, buy. And that lesson is going to make the next run impossible to stop. I want you to think about what happens when that moment arrives. When silver retests $100, breaks through, and keeps going. When it pushes to $120, $130, $150 without crashing. When industrial users start panicking because they cannot secure supply at any price. When the COMEX starts struggling to make deliveries. When physical premiums hit $20, $30, $40 over spot. What happens then? The paper market loses all credibility. The COMEX price becomes irrelevant. And the only price that matters is the price you can actually buy metal at. That is not speculation. That is the end game. And Monday's session just confirmed we are closer than anyone realizes. So here's my assessment. Tuesday morning brings one of two outcomes. Scenario 1, the COMEX tries to manage the narrative. They publish delivery data showing minor delays, they blame logistics issues, they settle more contracts in cash, and they hope the market does not notice. If that happens, physical premiums spike immediately. Dealers raise prices, industrial buyers accelerate orders, and the gap between paper and physical becomes impossible to ignore. Within 48 hours, we see $15 on $20, $25 premiums over spot. And once that happens, the paper price is irrelevant. Scenario 2, short sellers panic. They realize they cannot deliver metal they do not have. They start buying contracts at any price to avoid forced delivery. And the price gaps up violently. Silver opens Tuesday at $85, and within the first hour hits $95 or $100, $110. Vertical move. And once it starts, it does not stop, because there is no physical supply available to absorb the buying. Both scenarios end the same way. The paper market loses control. The only difference is timing and magnitude. But here is what you need to understand. If you are waiting for clarity, if you are waiting for confirmation, if you are waiting for the perfect entry, you are going to miss it. Because by the time it is obvious to everyone, the metal will be gone. Monday's session was the warning. Physical premium spiking while the paper price stays flat is the signal that the system is breaking. And the entities that crashed silver on Thursday are running out of options. They can dump the market again. They can trigger another cascade. But every time they do it, they expose themselves a little more. Every crash wakes up a few more buyers. And every disconnect between paper and physical convinces a few more people to ignore the COMEX and just stack metal. Here is what I am doing. I am not watching the price. I am not checking charts. I am not trying to time the bottom or catch the top. I am stacking physical metal. I am holding it outside the banking system. And I am ignoring the noise because the price action between now and the endgame does not matter. The only thing that matters is whether you have metal when the system breaks. And it will break. Monday just proved that. The crash was not the end. It was the beginning. And Tuesday morning is when the market starts to realize it. This is the Asian guy. Markets closed 2 hours ago. The data is clear. The verdict is in. Get your metal now before the COMEX admits what the premiums already prove. There is not enough silver to honor the paper claims. And when that becomes public, the price you see on the screen will be irrelevant. The only price that matters is what you can actually pay to get metal delivered. And that number is already $12 above spot and climbing. And